everyone, welcome to this webinar and thank you for joining. I'm Wael Makaram, I'm market analyst at ICM.com. We will be running this webinar every Monday in order to discuss what's coming in the week and also apply some technical analysis on the charts in order to have better opportunities throughout the week for trading. So first of all, we're going to talk about the latest, what happened during the past couple of days, especially over the weekend. There was a meeting mainly on Thursday between OPEC and other producers, and it was everyone was paying attention for this meeting due to the latest plunge in oil prices. We saw a sharp drop in oil prices in the first quarter, and this also extended through the beginning of April. So these oil producers or top oil producers uh, had a meeting in order to try to ease or cut their production in order to offset the drop in demand for oil that happened due to the spread of the coronavirus. So this meeting ended with the result to cut 9.7 billion barrels in production in May and June, and also this will be reduced to 7.6 and again to 5.6 in the coming till the end of 2020 and from 2020 till the end of 2021. So this was the meeting outcome. We didn't see much of a response in the market. We're going to talk about oil prices in a while. We're going to discuss it. We didn't see much of a response in the market to the current decision or the current deal due to, since a lot of investors still believe that there should more to be done, especially that there is a huge difference between the drop in demand and the offered cuts by OPEC plus. So we're gonna first start with mentioning the top economic events to happen or to come this week. Today it's shy, especially with the European markets closed. Tomorrow the activity is also shy during the day. We start late with the American Petroleum Institute report on crude oil stock at 20:30 GMT. The crude oil inventories or crude oil stock in the United States were on the rise for the past couple of weeks. This was due to the latest developments in the oil market. What is most important on tomorrow's economic figures is the trade balance from China. We have the trade balance for March. We saw a huge deficit of $7.09 billion in the trade balance in China in February due to the coronavirus outbreak. We saw a huge plunge also in exports. However, now the economic still we see still some plunge in exports, but also a sharper plunge in imports, which could result in a trade surplus in the trade balance, which is expected. We expect a trade surplus of 18.55 in March, so a sharp rebound from a negative 7.09 to 18.55. This is on Tuesday. On Wednesday, it's a bit busy with CPI consumer price index coming out from France, Spain, and Italy. No major changes expected since the prior reading on all of them. However, the first solid economic data to be witnessed is the retail sales from the United States that would show the effect of the coronavirus on the US economy, especially the retail sales that has a big importance and significance among the economic indicators. The consensus is a negative 7%, which could be the largest plunge in history due to as the coronavirus suspended economic activity and suspended the activity in general, leading to sharp plunge or sharp drop in retail sales, expected negative 7. So this could be the first solid economic indicator to show the effect of the coronavirus on the US economy, following what we saw already from in the jobs or in the labor market. Also, industrial and manufacturing production expected to drop minus 4.2 and minus 3.9%. Business inventories is for February and not for March, so nothing much to look out for. And also, the Bank of Canada will be meeting to decide on interest rates. There are expectations that interest rates will remain on hold at 0.25%. The Bank of Canada lowered interest rates recently from 1.75% to 0.25% in order to support the economy to combat the effects of the coronavirus on the Canadian economy. And still, there are some expectations maybe of the Bank of Canada, if the bank will move to do some additional support to the economy, it wouldn't be on interest rates or negative interest rates. Maybe it could be for asset purchases program. Also, the Bank of Canada interest rate decision will be followed by a presser by the governor Pelosi. The crude oil inventory is the weekly oil report by U.S. Energy Information Administration. Last week, we witnessed the record weekly rise in crude oil inventories, 15.17 million 15.17 million barrels. This week, we expect also a rise of 9.271 million barrels. Also, after this, we have the Beige Book. The Beige Book will give us a hint on the performance of 12 districts in the United States. We could expect some negativity or several districts expressing the effect of the coronavirus on the economic activity in these districts or in the United States. That we've been seeing some surveys showing that the economy has been affected sharply. Also on Thursday, we have a series of events. We start early with the employment change and unemployment rate from Australia. Minus 40,000 is a little bit in the range between what we've been seeing recently in Australia's labor market. Unemployment rate up 5.5% is not of a big deal, since we've been ranging between these numbers in the labor market in Australia recently, before seeing the pandemic or before encountering the coronavirus. Also, we continue with the German consumer price index. Also, nothing much to expect, 0.1%, 0.1%. Industrial production in the Eurozone for February also and not March. So though we can see a plunge of 0.2% in the industrial production in the Eurozone. The housing starts and building permits in the United States also, they're dropping, 1.3 million for building permits and 1.307 million for housing starts, well below prior claims. We've sharp and initial jobs claims for the past 3 consecutive weeks, and this week we expect a rise of 4.606 in jobless claims. The coronavirus is weighing a lot on the labor market in the United States, leading a lot of people to file for unemployment claims. Philadelphia Fed manufacturing expectations of a drop to negative 30. Negative 30 is the lowest since the financial crisis back in 2009. The activity on Friday is a bit shy, with the only focus being on the GDP figures from China. The first quarter GDP figures is the first reading for the first quarter GDP in China. So this will show the effect of the coronavirus on the Chinese economy. We are expecting a contraction of 10%, though the Chinese economy started to signal some signs of recovery in March, but the plunge in February was sharp. January and February was sharp, so there are expectations for a crunch or a contraction of negative 10% for the Chinese economy in the first quarter of 2020. Industrial production still also in the negative territory, a contraction of minus 7% versus prior, but better than prior reading of minus 13.5%. The Eurozone consumer price index, as prior, we expect a reading of 0.7% without any change. And also the US Baker Hughes oil rig count, we've witnessed a series of drop in the oil rig count in the United States due to the drop in oil prices. The drop in oil prices forced producers to cut their production and also to pause the work of some of their oil rigs. So this is for the fundamental aspect, or for the major economic indicators to be focusing on this week. Now we're going to move to have some close look at the charts on the performance of some major currencies, commodities, and the Dow Jones. So if you have any questions, please write them down before we move to the technical aspect, if you have any questions on the fundamental side. Okay, so we're gonna start mainly with the oil, since everyone is asking about oil, especially after what we've witnessed recently. So oil prices, as we know, the effect of the coronavirus weighed on the economic activity, leading to lower demand around the world. So this demand also affected negatively prices. The drop in demand and supply was surging due to the price war that emerged between top producers following the disagreement that happened on March 5 and 6 between the top oil members. So this led to a drop in oil prices to their lowest levels since 2002. What happened today? A lot of investors expected a sharp rise in oil prices due to the cuts agreed by OPEC Plus. However, if we just have a small look on the numbers, there are some expectations that the demand will drop by almost 30 to 35 million barrels, while the cuts could reach at better at an optimistic level. So it can reach up to 9.7, the one that they talked about. But also there could be some demand from the International Energy Agency for reserves. This could support a little bit the bias or the ambience for oil prices, but still currently we didn't see much of a move following the OPEC the OPEC meeting. If we apply some of the just so we could fund the FIBO retracement, we saw prices rising during the late March, early April, and then the market corrected almost 76.4 retracement, and now we're trading between the 61.8 and 38.2 FIBO level on a smaller time frame. If we have a closer look on the hourly chart, we can see almost a sideways move in the market. So here it was the bottom, and we saw a quick rebound and then a small corrective wave. We are trading almost in a consolidation zone, awaiting some more clarity on the market. So in order to decide whether the market is going to go up or down, we're trading almost in the 50% range of the recent swing from the bottom to the high. The market moves from 19 almost to 27. Now we're trading near 23.6, or almost near the 50%. If we apply some of the technical indicators, so here we can see the 100 and 200-hour exponential moving average in blue and red. The price is still trading below them. We're trading between almost near these prices for the past couple of sessions. This meaning that the market is still in a consolidation zone, awaiting some drivers in order to move next. Oil, the RSI is in the medium territory near 50 levels, so neither oversold, neither overbought. We're near neutral levels, and the price is trading now near the 20-hour exponential, the 20-hour simple moving average, which is the middle band of the Bollinger Band. Here we are seeing the bands closing. We are seeing the bands closing on each other, signaling lower volatility in the market, awaiting as we said, some more clarity in order to witness a sharp move or a sharp rally, and prices either up or down. Here also we can see the bands were wider when the market was going down, and here when the market started trading in range, the bands are closing in on each other, awaiting for the next move. We're still very far away from the 100 and 200-day exponential moving average. We're gonna move to currencies. So we start with the dollar index. The dollar index, we witnessed some seesaw move, especially after the interventions of a couple of central banks, which affected the currency market. So here the market was going down at the beginning of the pandemic spread in the United States. So the spread started in February 20. So here we can see February 20, it was a reversal, a clear reversal, bearish engulfing signal, and the market started dropping. And then here we got some recovery as European Central Bank and the Bank of England took some steps in order to ease the impact of the coronavirus on the market. So the dollar rallied sharply against these currencies. However, when here the Federal Reserve announced its commitment to buy as much as needed in assets to support the economy, the dollar had another move down. So we are back to mainly the levels that we've been trading in before the pandemic spread in the United States. So this can tell that since all the central banks took the same activity or the same steps to combat the coronavirus, they all eased their monetary policy. So we are now waiting for fresh clarity on the effect or real impact of the coronavirus on the economic indicators in order to know where the next move could be. So if we apply some of the technical indicators, So here we can see the market is still trading near the 100-hour exponential moving averages in the middle, also near the 20. For the past 2 weeks, we're trading near the 20-day simple moving average, and RSI is a neutral 50. So nothing much to expect from the dollar. We have to wait for the economic indicators coming up this week. If we expect some a little bit of a relief for the dollar, we could find some resistance near these upside levels near uh okay, so somewhere near 101, and the next level comes in near almost 102.50, 102.60. Okay, for support, we expect some support near this low, the previous low, and it's almost coinciding with 100-day exponential moving average. So it's almost near 98.40 level, and again at the Bollinger Band low, maybe near the previous gap at 297.50. So this is for the dollar index. The euro is completely opposite the dollar index. We saw a little bit of a move, and then another move down, which led to a fresh low, a corrective move, and then another corrective move inside, another move, and then another correction to the latest down move. And now we're seeing a reversal, a sign of reversal could be, which the market failed at the highs of at April highs or last week's high. So we failed near 109.60, and then the market is moving down near 109 level. We expect some support near lows of, maybe if we go on the smaller chart, it's going to be clearer. Could be finding some support here near the trend line, and you're almost, the market is trading almost in this shape. It's almost a wedge. So the market failed on the third point of the line. So if we merge these two highs, the market reversed exactly at these lines, and now we're trading near the trend line, combining the lows of April 6 and April 9. For further support, we expect some further support near lows of maybe 108.30, and again at 107.70, and resistance could be seen after breaking a high of 996, almost 970. We could expect some resistance near highs of 1040 again. So this is for the euro dollar. For the British pound succeeded today in breaking towards its highest level since March. We've been trading in somehow a consolidation zone for a while. Uh, the market had witnessed some indecision and late March and early April. However, we witnessed after a little bit of a drop and then a sharp recovery, and the market is still on the upside. So we expect we're trading near the 61.8% level Fibonacci retracement. So here it's normal to expect some uh, resistance, since most of the traders do look for resistance near 61.8 retracement level for the Fibonacci. For further resistance, we could look for the 76.4, which is almost at the 2760 and almost its lows of February and again of March. If we're gonna go closer at a look, okay, so here we can see a series of higher highs, and then here another higher high, but it's still a little bit shy, just with small numbers. So we have to at least uh, stay for a while here, or even merge higher towards maybe 25.50, 25.60 to have some positive bias on the British pound. Also, we have to keep above. There's no clear upset. Like the market rebounded from the bottoms, and then we're trading here near sideways. Though we were able to make a higher high, but we're still trading almost in a range move. We expect some resistance, as we said. The major resistance come in at maybe 2760 to 76.4 retracement, the Fibonacci retracement. Also, some resistance could be witnessed here at 2620, and support is seen near lows. Major support could come in. Major support, it's very far from here. It's almost 2170, and the minor support could come in at almost 2320. So if we can expect some higher volatility in the market, maybe we can witness these levels throughout the week. For the Japanese yen, it's been benefiting recently a little bit for its safe haven status. So all the rallies were sold. So here we had a little bit of a rally upside, and it was sold due to uh, safety demand here as indices recovered. Also, the market, the dollar yen edged higher. However, now we're starting to see some move down, especially today. We're down to almost 107.70. We expect some support, maybe near lows of 106.90, and again at 105.14, and resistance level is seen here near high of 109.30 almost, and again near this recent high. So if we go for some of the indicators, so here we can see that we're trading near the two. Now we crossed below the 100 and 200-day exponential moving average, also below the 20-day simple moving average, and we are edging lower towards the lower band of 106.55 in the dollar yen. Also, the RSI is still maybe in the neutral zone between 40 and 60, but it is moving a little bit lower from 54 to 45. This is for the dollar yen on the daily chart. If we go closer for we started seeing a little bit of a move down in the dollar yen, so the market is moving a little bit down. We could expect some negativity as long as we were below this trend line that combines the highs of April 8 and April 10. And also the RSI is dipping into the negative territory. The 14-hour HR is dipping for RSI is dipping to the negative territory, to the below the 30 territory. Sorry again. So this is for the dollar yen. The Australian dollar is benefiting from the fact that Chinese economy is recovering slightly from the coronavirus outbreak, especially that we saw some encouraging signs last week in the economic indicators, supporting the fact that a small rebound happened in March after it bottomed in February. So this was a little bit supportive. We witnessed a recovery here and then another corrective wave for this move higher. And then we have also a similar leg higher for the Australian dollar. Could be eyeing the resistance line here somewhere near 64.30. If we go for some of the indicators, we are trading near the upside band of the 20-day Bollinger Band. Also, we are approaching the 100 and also the 200-day exponential moving average, and the RSI is moving above near the 60 territory, which is a little bit of a bullish sign. If we go for the hourly chart, we've been consolidating for the past couple of hours near the top and awaiting some fresh fundamental drivers, maybe to pose either for a move upside or to see some retracement near the 100 and 200-hour exponential moving average somewhere here. So this is for the Australian dollar. The Canadian dollar, the USD against the CAD fell recently, and we saw a drop towards March lows. And this was due to some assumptions that the Bank of Canada won't be moving or taking any further additional easing steps currently, and we are in a wait and see mode. And also this was supported by some assumptions of positivity in oil prices. We all know that the strong correlation between the Canadian dollar and the oil prices. So here, as we saw oil prices dropping and the Bank of Canada also taking some monetary policy easing measures, the Canadian dollar was losing ground against the United States dollar, and we saw a sharp rally. However, when this erupted, we saw some corrective move in the pair. We could maybe apply some the Fibonacci levels in order to check. This is the recent swing from 132 to the top. We can see that the market is stalling near the 50% retracement, and we witnessed some resistance near highs of 123.6. We could find some support near lows of 61.8, which could come at 137.60 throughout the week. If we have a closer look here, the market is consolidating near the lows. We could see here maybe we can have a trend line. And here's a trend line combining all the tops. So we could see maybe some move down as long as we are below the trend line that is combining the tops of this rally. So we have here a solid support near 139. We expect some support again if it was broken near 37.50, and resistance is seen near this level. So if we go for some indicators to see what they are giving us, we're trading below the 100 and 200-hour exponential moving average. We're trading near the upper bound of the 20-hour Bollinger Band, and the RSI is signaling slightly higher towards 57, edging towards a high of 60, which is starting to give us some maybe some bullish move in the USD CAD. So we have some different uh, some different vision between the daily chart and the hourly chart. So this is for the USD CAD. For gold prices, they're still edging higher, stalling near 1690 almost. We have we have an uptrend line almost trading, supporting the prices. So this is for classical technical. If we're gonna look at the H1, if we take a look at some of the indicators, we can see the market is trading above the 100 and 200-hour exponential average. We found some support during late March, early April near these levels. And now we're trading also at the top of the 20-hour band. We can see that the range or the sideways move that happened since Thursday, since early Thursday, we saw a little bit of a consolidation move. So this brought the bands closer to each other, awaiting some fresh drivers, so the market can move either upside or downside. We can see the RSI, the 14-hour RSI is trading near the 70 level after being overbought for a period of time. We saw lower highs for RSI, so now we have to check up for the next move here. We can see some bullish engulfing candle on the hourly chart. So you have to monitor closely gold prices. If you go for the daily chart, we can see that the market is still away a little bit from the upper band that sits um, at almost 1720. So we're trading near the previous high. Now, also the market is clear. We're trading above the 20 simple moving average, the 100 and 200 daily exponential moving average. Also, on the RSI on the daily chart is trading between 60 and 70. So for Dow Jones, we witnessed some drop today towards 23,500, 150 after the rally, the strong rally that we witnessed last week. We saw 4 days for the Dow Jones, some correction. So maybe we had a wave, a drop and then a correction, and then a drop and then a correction, a smaller correction for the upside, and then we had another move, and now we stalled near this level. So if we apply so the market stalled near 50% retracement on the Fibonacci. We could expect some support near lows of 38.2 or a near low of 22,400 throughout the week, and resistance could come in an optimistic or in a bullish scenario. The market could find some resistance near highs of 25,106, which was also some good point in early March, where the market was dropping. So we have to mind these two levels for support at 22,400 and for resistance 25,000. So the market is trading now currently in between. If we go for the hourly chart, so here also for the hourly chart, we are approaching the 100 and 200-hour exponential moving average. The market is trading near the lower band of the 20-hour Bollinger Band, and here we had a sharp candle down, removing all the positivity that we earned for the past couple of hours. So this is for the Dow Jones. The RSI is dropping away from the 50 level, approaching the 40 level. We're trading now near 42. So we could expect some minor support for the Dow Jones near 22,900, and as we said, 22,400, which also coincides with the 200-hour exponential moving average. And for resistance, we should mind the high that we witnessed last week, which was 23,874, and for a higher scale, 24,400 and 25,100. These are the resistance levels for the Dow Jones throughout the week. So this is mainly it. If you have any questions, please do write them down in order to support you. And if you want us to maybe go over some other instruments, also feel free to ask about any instrument to go over it. I can see a couple of hands, so please, if you have questions, please write them down so we can answer them. Okay, so what's the benchmark for gold? So recently, gold, as we said, gold is benefiting recently from all the monetary policy easing measures that were taken by central banks. So that was supportive for gold. Earlier, we witnessed a sharp drop in gold due to investors or funds liquidating their gold position to support their portfolios. But for gold, if we have a clear technical overview on the daily chart, we're trading above the 100 and 200-hour exponential moving average, which should be taken as positive. Also, we're trading above the 60 level for RSI, which was also a positive signal. So this is for gold, but please, you have to mind that all the information and analysis that are given here are only opinion, and they aren't they shouldn't be taken as a signal whether to buy or sell a certain currency or commodity or stock or any instrument provided by ICM. We don't provide any investment advice. So this is all uh, an analysis based on the technical indicators and what these technical indicators do mean. So this is not a recommendation. It is just a clear analysis on what these economic indicators mean, and they should be taken for educational purposes and not for trading purposes. Any other questions? So we have another question. Which are the best which are best at this moment at low risk investment? Well, and this kind of investment, y- you have to look for you have to look for some okay, let's answer first this question and then we'll move to okay. So what do you consider a low risk investment? So currently there you can't assess with the current market volatility and the market fluctuations and the uncertainty concerning the time span of the coronavirus. So we can't assess which are lower risk assets than others. We have to witness what the market is going for and what we are assessing in terms of market volatility and market moves. What we can do in order to avoid any high risk is to take care of our risk management or money management. So we do try to lower our risks or entire risks by proposing money management properties, especially uh, in such trading environment. So it's not basically about a certain instrument because all instruments are being affected recently. Either the currencies that are affected by central bank policies, by monetary policy easing, by economic indicators, by the suspension of the economic activity. Also, stocks they are being affected by uh, by the suspension of the activity. So a lot of businesses are suffering. It depends on the industry. There are some industries that are doing better than others. So if we're going to talk about stocks in particular, we have some defensive stocks. ICM do provide trading of particular stocks in the United States or US stocks. So some of them they could be better off than others because they are considered defensive. Some of them they provide medical equipments, also some food and other type of products which are a need for consumers at the current, so they could be a better investment than other investments that are considered uh, as minorities for the consumers. Okay, there is a question, but it's not completed. It starts with how to recognize. I'll go right now. Gold will move upward or downside. So, sir, as I repeat again, we can't give a direct advice. We can't give a direct direction for the market. The market is moving. We can see gold is trading near the highs of March, near also its highest levels since almost 2013. But this doesn't mean that gold prices could rally further and not witness some maybe some correction if something happened in the market. So we can't give a direct signal where the market could be going up or down. What we can have a look at, the market is trading above certain simple moving averages and exponential moving average, which could be taken some positivity or some positive signal, but this doesn't mean that the market could be moving upward. We can't give a direct investment advice. So this is only a type of analysis, and you have to take your decision on your own. To what extent you rely on indicators? Well, I believe we should mix always. So you have to use the classical technical analysis, which is known as supports, resistance, trend lines, channels. We can rely on them, and also we have to rely on the indicators in order to see some the extent of some moves. So, but also you have to make sure to use a couple of indicators, and each one for a certain signal. So one of them to give you maybe a signal to enter the market. Another could give you a signal for whether the market is overbought, oversold, or still in neutral territory. So you have to use a couple of indicators in order uh, to have a direct signal from the indicators. One could be taken as a trend, the other could show you the volatility and the activity of the market, or the status of the market, whether it is in a neutral situation, it is an overbought situation, or an oversold situation. Why people will choose ICM for trading? Well, sir, ICM is regulated by different entities worldwide. We're a multinational. We provide support for clients to 24/5 multilingual support. We also offer a couple of trading instruments on the same platform, and we are always there to help our clients. So we are so many clients. If you are asking for the direct signal, and I said that we can't offer direct signal, this is because it is one of the main basics of the regulatory bodies that we are registered under. So that's why. Also, ICM. I'm not gonna talk precisely on ICM because we are here to define the market update mainly, but the ICM also is providing is supported by several is regulated by several entities, so it can support the client with all uh, under all jurisdictions. Also, we have insurance for the safety of funds of the clients that can cover up to 5 million pounds, or 5 million euros, or $5 million, depends on the jurisdiction that he is registered under. So we are trying to provide the client all the instruments to trade, and also all the safety aspects that a client could look for. You're most welcome. Do we have any other questions? Okay, which sector are comfortable to do the investments? So mainly there are sectors, there are the safe sectors that they witnessed recently the lowest effect in the market, which are the consumer discretionary and maybe staples. So these were the latest that got some effect. And also some of the healthcare companies, they were also positive because some investors, they believe that some healthcare companies will be able to find a cure or maybe vaccine and solve and be able to support us during this pandemic. So it depends on uh, on your risk appetite. So of course we have some high risk sectors, such as the energy sectors, that witnessed some sharp drop due to the drop in oil prices. Other industrials also took a hit due to the stoppage of the factory and the mining facilities. So it all got affected. Also, the real estate market is being affected. So maybe these are some riskier sectors than others. Some people do also prefer in this situation some entertainment companies. Since people do look for entertainment in current lockdown situations, so it depends on your risk appetite on and what kind of investment you are looking for. Sometimes we see divergence indicators and market. What type of decision should I could take? Well, that's a good assessment. So when we do apply some couple of indicators or a couple of analysis or a couple of types of analysis in order to have to match the signal. So whenever you have a matching signal, we can rely on. But when you have a couple of analysis tools, and each one is giving different signal or diverging signal, we can't be we it's better not to take risk and trade in the market. If this is your question, if I didn't answer you properly, please do write the question again, and I'll be responding. Because you have divergence in the indicators themselves. So if you're using a couple of indicators, you have divergence between indicators, and sometimes we witness some divergence between the indicator and the market itself. So this is what I want to make sure of you're asking about. Sir, what do you mean by what is the full form of ICM? And please, if you okay, anybody have any questions? Any more questions? Okay, so there's another question. Okay, so you're talking about RSI. It says bullish while the MACD bearish. It depends on the. You have to make sure that you are using almost the same periods in order to show the same period of time. So if you're using maybe a shorter period on the RSI and the longer period on the MACD, so and maybe we can witness some sharp move in the recent periods that will of course show you divergence in signals. So the RSI could signal a drop and the MACD could signal rise. So this is what you have to take care of, which is in the first place, it is the period of the indicators that you are using. And when you have matching periods, so you have to make sure that that the indicators give you the same signal in order to trade. To enter a trade. If any of them is giving you an opposing signal to another, maybe there is not enough clarity in the market in order to trade it. So I prefer first you can set your period to be matching between two indicators, or and then take your trade whenever the signals between these two indicators are matching. Well, sir, I can repeat again. So mainly the risk that comes in with such type of trading. So what you can take care of in order to have lower risk is your money management. Since we offer we offer a variety of trading instruments. First, you can diversify your portfolio to have low risk. One, two, you can take smaller portions of each trade in order to so you can split your risk on different sectors and on different movers or assessments. So this you can have a lower risk among your portfolio or among your trading profile. There's a question about a little bit of an investment for the medium term or maybe longer term. So it depends on your risk appetite. So if you believe you are going to hold your investments for long and you believe certain sectors have suffered most, so maybe you can have a partial investment in these sectors, diversify your portfolio, and you can hold it for the years to come if you can see that the market is pulling back again to its normal levels. Any further questions? Okay, perfect. So hopefully we'll meet you on Wednesday. We have an educational seminar to show you how an introduction to technical analysis. We'll talk about the basics of technical analysis and how to use different types of charts. So this is for Wednesday. Hopefully we can meet you, and on we will be meeting every Monday in order to discuss the market fundamentals and technicals. So this is all for today, and thank you all for attending, and have a great day.